It is 1:55 p.m. Eastern on Thursday, January 22nd, 2026, which means the clock on our 6-hour window started at exactly 7:55 a.m. Eastern. And inside that window, the copper market just received a kind of update most people ignore because it does not look like a price chart. But it is. At 8 a.m. Eastern, Freeport-McMoRan posted its fourth quarter and full year 2025 results. And it is not just a corporate earnings update, it is a real-time, balance sheet-backed blueprint for what copper supply, costs, and cash flow could look like in 2026. Then at 10 a.m. Eastern, management stepped into the arena and laid out how they see volumes, timing, and the ramp that matters most. If you trade copper, invest in miners, watch inflation, care about the dollar, or you are simply trying to make smart decisions for wealth preservation, this is one of those moments where the market gives you information before it gives you confirmation. And the difference between information and confirmation is where the real edge lives. Here is what I want you to do mentally right now. Forget headlines, forget hype, forget the daily drama of one candle up, one candle down. In commodity markets, you do not get paid for reacting to what already moved. You get paid for understanding what is likely to move next, and why. Because copper is not just an industrial metal. Copper is wiring, infrastructure, power grids, data centers, EV supply chains, HVAC systems, appliances, construction, and the quiet backbone of real estate investing. Copper is what the physical economy uses to express demand. So when a top-tier producer tells you in plain numbers how many pounds they expect to sell, what it costs them, and what cash flow looks like under different price decks, you are not reading a report. You are reading the market's stress test. Now, before we go any further, quick and clear, this is education and market analysis, not personal financial advice. No one size fits all. Your time horizon, risk tolerance, and portfolio structure matter. With that said, let me tell you why today's Freeport update matters more than most people realize, and why it can change how you look at copper for 2026, starting right now. Freeport reported fourth quarter 2025 net income attributable to common stock of $406 million, or $0.28 per share. Adjusted net income attributable to common stock was $688 million, or $0.47 per share. Those two numbers are not just accounting. They are the bridge between narrative and reality. Because in the same breath, Freeport tells you that fourth quarter results included significant charges tied to operational disruption and recovery. That matters because it explains why volume and cost metrics look the way they did. And it matters because it frames the real question for 2026. The real question is not, did they beat or miss some estimate? The real question is, can the copper machine ramp back up? And if it does, what does that mean for supply, for margins, and for the broader copper tape? Now listen to the production and sales numbers because these are the heartbeat. In the fourth quarter of 2025, consolidated production totaled 640 million pounds of copper, 65,000 ounces of gold, and 25 million pounds of molybdenum. Consolidated sales totaled 709 million pounds of copper, 80,000 ounces of gold, and 22 million pounds of molybdenum. So even if you know absolutely nothing about mining, your intuition should fire right there. Sales were higher than production in copper and gold, which points to inventory dynamics and timing. That is not a footnote. That is a clue about how supply hits the market, and when. Now look at the realized prices, because this is where the story gets dangerous in a good way. Average realized prices in the fourth quarter were $5.33 per pound for copper, $4,078 per ounce for gold, and $23.77 per pound for molybdenum. Let that sink in. A realized copper price above $5 per pound is not a casual regime. It is a high-price environment that changes everything. It changes which projects are viable. It changes which expansions get funded. It changes how quickly supply responds. And it changes the entire psychology of the market. This is why copper is so powerful as both a growth barometer and, in certain environments, a practical inflation hedge. Not because copper is a safe haven like gold, but because inflation, Infrastructure spending, electrification and supply constraints can collide in one metal and create a sustained tightness that shows up in pricing. But here is the twist that too many people miss. In copper, a high price is not automatically bullish forever. A high price is also an incentive. It is an invitation for capital to come back into the system. So the question becomes, how fast can the system respond? And that brings us to the most important part of today's update: 2026 guidance and timing. Freeport expects consolidated sales to approximate £3.4 billion of copper, 0.8 million ounces of gold, and £90 million of molybdenum for the year 2026. They also gave a first quarter 2026 view: about £640 million of copper, 60,000 ounces of gold, and £22 million of molybdenum. Now that is the headline number most people will repeat, but repeating it is not understanding it. Understanding it means asking, when does that copper actually show up? Freeport states that estimates for 2026 assume a phased restart and ramp-up of the Grasberg Block Cave underground mine, beginning in the second quarter of 2026. And they add something even more critical. Based on current estimates, approximately 60% of consolidated copper sales and 75% of consolidated gold sales in 2026 are expected to occur in the second half of the year. That single sentence is a calendar, and calendars move markets. Because it tells you that 2026 is not a smooth supply story. It is back-end loaded. It is a second-half story. So if you are watching copper, and you are wondering why the market can feel tight, then feel looser, then tighten again, this is a big part of the answer. The supply is not just about how much, it is about when. Now let's go one layer deeper, because this is where the blueprint becomes a strategy tool. Freeport says unit net cash costs were $2.22 per pound of copper in the fourth quarter of 2025, and $1.65 per pound for the year 2025. For 2026, they expect unit net cash costs to average $1.75 per pound of copper for the full year. But they also explicitly say they expect $2.60 per pound in the first quarter. That means the cost picture is also front-end heavy. Costs are higher early, then expected to improve later as volumes and operations normalize. This is the kind of detail that separates casual commentary from real analysis. Because when investors look at miners, they tend to focus on the copper price. But miners do not live on copper price. They live on margin. And margin is price minus cost, multiplied by volume minus timing friction. So if copper stays elevated and costs normalize later in the year, the second half is where the operating leverage can show up. But here is the part that should make you sit up. Freeport also gives you a cash flow sensitivity check that is almost too straightforward. They estimate operating cash flows would approximate $8 billion for the year 2026, assuming prices of $5 per pound for copper, $4,000 per ounce for gold, and $20 per pound for molybdenum. Then they say, using recent prices of $5.75 per pound for copper, $4,700 per ounce for gold, and $23 per pound for molybdenum, operating cash flows for 2026 would approximate $11 billion. This is why the market cares, because that is the difference between a good year and a potentially explosive year in terms of cash generation. Now you might be thinking, okay, but cash flow is nice. What about the balance sheet? At December 31st, 2025, consolidated cash and cash equivalents totaled $3.824 billion. Total debt, including current portion, totaled $9.379 billion. They also frame net debt at $2.3 billion, excluding $3.2 billion of debt for downstream processing facilities. Whether you agree with that framing or not, the point is clear. They are showing you they are not operating from a position of financial fragility. And in commodity markets, financial fragility is what turns a normal cycle into a forced seller cycle. This matters because when the next liquidity crisis arrives, whenever it arrives, the biggest losses usually do not come from being wrong about the long-term story. They come from being right about the long-term story, but structured wrong for the short-term stress. That is why I keep telling you, The most underrated skill in investing is not prediction, it is survival. And this is where the conversation connects directly to retirement planning. If your goal is long-term compounding, you do not need to catch every move. You need to avoid the moves that permanently damage your ability to stay in the game. So what do we do with this information today? We use it to build a framework. Here is the framework, and it is simple, but it is not simplistic. Think in 3 layers. Layer 1 is the metal. Copper pricing, spreads, inventories, demand signals. Layer 2 is the producer reality. Volumes, costs, timing, capex, balance sheet. Layer 3 is the macro. Rates, dollar strength, fiscal policy, global growth, and liquidity conditions. Today's Freeport update lives in Layer 2, but it immediately informs Layer 1 and Layer 3. Because copper is currently being traded not just as a metal, but as a narrative. And narratives do not die when they are challenged. They die when the cash flows and volumes contradict them. So ask yourself, does this update contradict the copper bull case? Not really. It actually reinforces the idea that copper is strategically important and that producers are actively investing in growth. It reinforces the reality that demand is there, pricing is strong enough to generate enormous cash flow, and multiple expansion pathways are viable at incentive prices around $4 per pound. Yes, you heard that right. Freeport is saying, in more than one place, that some major projects can be supported with an incentive copper price around $4 per pound, or less than $4 per pound. That is not a small detail. That is a massive statement about the long-term floor for investment decisions. Because if the industry can justify growth at $4 copper, and we are well above that level, then the conversation shifts from can they invest to how fast can they invest without creating future oversupply. And that is the tightrope. Now let's talk about the growth projects, because this is where a lot of investors get hypnotized. They hear growth and they think guaranteed upside. That is not how this works. Growth projects are options. They are potential future supply. They are also potential future cost overruns, delays, permitting friction, and capital intensity. Freeport describes major US growth opportunities, including the chance to more than double concentrator capacity at the Baghdad operation in Arizona, with studies indicating the opportunity to increase copper production by 200 to 250 million pounds per year. They reference incremental capital costs around $3.5 billion and talk about a 3 to 4 year completion timeline, with an incentive copper price around $4 per pound. Then there is South America, where they describe development at El Abra in Chile, identifying a large sulfide reserve that could support a potential major mill project, potentially adding over 700 million pounds of copper production per year. They plan to submit an environmental impact statement to Chile regulatory authorities in the first half of 2026, and they indicate preliminary estimates suggest economics supported with an incentive copper price of less than $4 per pound. Then there is Indonesia, where they talk about a phased restart beginning in the second quarter of 2026 at Grasberg Block Cave, with a plan that includes restarting production blocks 2 and 3 in the second quarter and the potential restart of production block 1 during 2027, and an expectation that about 85% of total production at normal operating rates could be restored in the second half of 2026. This is not just a company story. This is the global copper supply map being updated in public. Now let's pause and ask the question that matters for you watching this. Why should you care about one company's volumes and costs if you are not buying the stock? Because copper is not priced by your opinion or my opinion. Copper is priced by the marginal ton, the marginal pound, the marginal inventory movement, and the market's expectation of future scarcity or future abundance. And Freeport, by scale, by asset quality, and by global footprint, influences those expectations. More importantly, Freeport's report gives you a clean way to think about copper as a system, not as a chart. Here is the system in plain English. When copper is expensive, the world wants more copper. But the world also wants to build more copper supply. Building supply takes time. If demand grows faster than supply can be built, price spikes can persist. If supply ramps faster than demand, prices correct. If a liquidity crisis hits, everything can sell off regardless of fundamentals, because forced selling does not care about your thesis. So your job as an investor is not to guess the price tomorrow. Your job is to understand which part of that system we are in and which part we are moving toward. And that is why the timing details in this update matter so much. If 60% of Freeport's copper sales are expected in the second half of 2026, that tells you the early part of 2026 can remain more sensitive to tightness. Then the second half becomes the moment where supply expectations can shift, not just for Freeport, but for broader sentiment. Now, I want to connect this to something you can use today, even if you are brand new. In commodity markets, there are two kinds of surprises. There are price surprises, where the chart moves before the narrative catches up. And there are narrative surprises, where the narrative moves before the chart catches up. This morning's update is a narrative surprise. It gives you a structured way to think about the next 12 months that is rooted in actual operations. So how do you turn that into a practical approach without falling into the trap of buy this now thinking? You build options. Not options contracts necessarily. I mean options in your decision-making. One option is to treat copper as a macro indicator. If copper is strong, it can signal that industrial demand and risk appetite are alive. If copper rolls over hard while producers are still projecting strong ramps, it can signal that demand is weakening or liquidity is tightening. Another option is to think about exposure through different vehicles. Some investors prefer broad commodity baskets. Others prefer diversified miners. Others prefer to keep exposure indirect through sectors that benefit from electrification. The right choice depends on risk, volatility tolerance, and time horizon. Another option is to use copper as a risk management trigger. If you are doing real estate investing, copper price trends can be a practical clue about construction cost pressures and the inflation pulse in building materials. It is not perfect, but it is informative. Now let's talk about the macro layer for a second, because copper never trades in isolation.
Fiscal policy matters. When governments run large infrastructure programs, subsidize energy transition, or expand deficit spending, copper demand can get structural support. But fiscal policy also matters because it influences inflation, and inflation influences rates, and rates influence the dollar, and the dollar influences commodity pricing globally. So the copper trade is not just about EVs and grids. It is also about rates and liquidity. This is why you can see copper fundamentals look bullish, and yet price action can still chop or correct. Because the market is constantly switching between two dominant lenses, the physical lens and the financial lens. The physical lens is pounds, tons, ore grades, smelter capacity, shipping, and real consumption. The financial lens is positioning, dollar strength, yield curves, risk appetite, and margin availability. When the financial lens dominates, copper can trade like a risk asset. When the physical lens dominates, copper can trade like a scarcity asset. And in 2026, it is very possible we will see the market bounce between those lenses multiple times. So here is the most important thing I can say today, and I want you to remember it the next time you see a dramatic move in copper. Copper does not need a new story. Copper needs a new constraint. And constraints can show up as time, cost, or logistics. Today, Freeport gave us a clear constraint: time. The big ramp is second-half weighted. The restart is phased. Costs are higher early, improving later. Downstream processing adds variability. That means the when is as important as the how much. Now I promised you something practical, and I'm going to deliver it right now. I want you to use what I call the copper reality check, and it is built on 3 questions. Question 1. What are the volumes, and are they front-loaded or back-loaded? For Freeport, 2026 sales are expected around 3.4 billion pounds of copper, and a large share is expected in the second half. Question 2. What are the costs, and are they rising or falling as the year progresses? For Freeport, unit net cash costs are expected to average around $1.75 per pound for 2026, but they explicitly guide higher in the first quarter at $2.60 per pound, with improvement expected later. Question 3. What does cash flow look like under conservative assumptions versus current pricing? They tell you about $8 billion of operating cash flow using $5 copper, and about $11 billion using recent prices around $5.75 copper. When you have those three answers, you can stop guessing and start thinking, because now you can frame the copper market like a professional, not as a single number, but as a probability distribution. Now, let's talk about why this is so compelling for the average person who is not a trader and does not want to stare at charts all day. In retirement planning, people often get trapped in two extremes. They either avoid volatility entirely or they chase whatever is moving. Neither extreme is optimal. The smarter approach is to build a plan where volatility becomes something you can tolerate, because you sized it correctly, diversified it correctly, and you understand why you own what you own. If you believe that the world is structurally electrifying, that grids need upgrades, that data centers expand, and that infrastructure remains a priority, then copper can make sense as part of a long-term theme. But the way you express that theme matters. Some people express it with broad equity exposure, because many businesses benefit from electrification without taking pure commodity price risk. Some people express it with miners, understanding that miners bring company risk, jurisdiction risk, operational risk, and cost risk. Some people express it with commodity exposure, understanding that commodities can be volatile and can behave differently during liquidity stress. There is no universal answer. There is only a framework. And the framework is: identify your goal, match the instrument to the goal, then size it to survive the worst week, not the best week. That is wealth preservation. Now, I want to add a critical caution here, because this is where people get emotionally hijacked. When a metal is hot, the internet fills with certainty. You will see people say copper is going to the moon, or copper is about to crash, with the same confidence, sometimes in the same hour. That is why I want you to incorporate X into how you track sentiment, but not into how you make decisions. Here is how to use X correctly. Use X like a smoke alarm, not like a compass. When you see a narrative dominate X, whether it is bullish euphoria or bearish panic, that is a signal that positioning may be getting crowded. Crowding does not tell you direction. Crowding tells you vulnerability. So if you open X and you search for copper, or you search for the Freeport ticker symbol FCX, do not look for the loudest opinion. Look for the new information, the first-hand numbers, and the shifting language. Watch how quickly people move from "this is obvious" to "this is complicated." Because that language shift is where reversals are born. And today, the new information is not a rumor. It is a filing. It is guidance. It is a schedule. Now let's bring this home with the most powerful insight from this entire update. And I'm going to say it plainly. Freeport just told you that 2026 is a tale of two halves. The first half is recovery, higher unit costs, and a market that can remain sensitive to supply tightness. The second half is where the bulk of sales are expected, where operations are expected to restore a large share of normal rates, and where cost performance is expected to improve. So if you are watching copper and you are trying to understand why the market can feel like it is holding its breath, this is part of why. The market is waiting for the ramp. Not in theory, in dates. Now, let me connect this to something that will immediately make you see copper differently. Copper is one of the few assets that can simultaneously behave like a growth barometer and an inflation hedge, depending on the macro regime. If the economy is expanding and liquidity is healthy, copper can rise because demand rises. If inflation expectations rise and infrastructure spending accelerates, copper can rise because the world is bidding for finite industrial inputs. But if rates spike, credit tightens, and a liquidity crisis emerges, copper can drop sharply, even if the long-term story remains intact. So your job is to avoid being fooled by a single storyline. Your job is to track the regime. And regimes are driven by fiscal policy, central bank credibility, credit spreads, and the flow of liquidity. That is why this morning's corporate update is so valuable. It gives you a grounded anchor in a market that is often dominated by emotion. You can look at the numbers and say, okay, this is what supply could be. This is what costs could be. This is what cash flow could be under conservative and current pricing. Then you can overlay the macro question. Will the world be in expansion, inflation pressure, or liquidity stress? Now, I will give you 3 scenario lenses for 2026. These are not predictions. They are lenses. They help you avoid being surprised by the obvious. Lens 1. Steady growth with contained inflation. In this lens, copper demand holds up, producers ramp, and pricing may remain elevated but becomes more sensitive to supply additions. In that world, the winners are often the operators with low costs, strong balance sheets, and credible projects. Lens 2. Inflation resurgence, driven by supply constraints and spending. In this lens, fiscal policy pushes demand into constrained supply, and copper can act as a pressure gauge for the real economy. In that world, the market often rewards anything tied to hard assets, and the volatility can be intense. Lens 3. Liquidity tightening and risk off. In this lens, even good stories get sold. Copper can retrace quickly, not because the world stops needing copper, but because the market reprices risk. In that world, the priority is survival, liquidity, and not being overexposed to a single narrative. If you can hold those 3 lenses in your head, you stop being shocked by volatility. And that is when you become dangerous in a good way. Now, here is the part that should genuinely open your eyes. Freeport's report is not just about 2026 volumes. It is also about optionality. They are highlighting multiple growth paths: U.S. expansions, South America development, Indonesia ramp, and longer cycle deposits. And they are framing project economics around incentive copper prices around $4 per pound. This is not a company saying, we need copper at $6 forever. This is a company saying, we have levers that can work even at lower prices, and if prices stay high, cash flow becomes enormous. That is the definition of optionality. Optionality is what investors pay up for in cyclicals, because it lets the company survive the down cycle and thrive in the up cycle. But optionality also creates a strategic challenge for the commodity itself. If enough optionality gets funded, future supply can appear faster than the market expects, and the price regime can change. So the copper market in 2026 is likely to be a tug of war between 2 forces. Force 1 is demand pull from electrification and infrastructure. Force 2 is supply response, fueled by high prices and improved project economics. And the referee of that tug of war is liquidity. Now I want to close with a simple, actionable takeaway that you can use right after this video. If you are trying to make sense of copper right now, stop staring at the price in isolation. Instead, track 3 things over the next weeks and months. Track the calendar of ramps and restarts, because timing is supply. Track unit cost guidance and whether it improves as expected, because costs determine how much supply is economically sustainable. Track macro liquidity conditions, because liquidity determines whether fundamentals get respected or ignored. That is the blueprint. And today, within the last 6 hours, Freeport just handed you a large piece of it. If you want, in the next video I can take this exact same framework and apply it to silver, because silver is not just a precious metal story right now. It is an industrial demand story too, and it connects directly to inflation hedge behavior and wealth preservation psychology in a way most people underestimate. For now, your move is simple. Do not chase headlines. Chase understanding. If you found this valuable, make sure you are subscribed, because this is the kind of market that rewards people who think in systems, not people who react to noise.